5 Startup Financing Strategies for New Businesses. Sourcing the initial capital is often the most challenging aspect of starting a new business. However, there is often a shortfall between personal hard-earned money and that required to confidently start a business. Total dependence on a business loan is also not a great solution. As a self-starter, diversifying the resources will lower the risk alongside finding ways to reduce initial overheads. Finding the source of funds could be tricky. The typical mistake of business startups is forgetting to plan and being in a rush to get to market. Steps for fast financing for startup business. Step 1. Go back to your business plan and analyze your budget. Then, look at your forecast sales and expenditures by month. Do not forget to be realistic. Determine what the months or days that there could be lower sales due to seasonality. Know how much resources you have right now that you are ready to finance some costs in the budget plan. Step 2. Determine what precisely is in the budget plan you would require financing and how much you need. Typically, expect that startup business will be losing money in the initial years. The high spending rate will continue until the company hits break-even. Determine also if your business is highly seasonal, in example, toy manufacturing. The cash flow of this type of business can be unpredictable. Step 3. Consider some contingency funding because there may be unexpected problems that entail costs. Review back your business plan and know what the risks to manage. Step 4. Review of all your forecast and figures, decide how much financing you require. Thus, access to startup financing is used to cover development costs and startup losses. Hence, the sources of finance are your own hard-earned money, friends, family and investors. Step 5. Determine what short-term and long-term that will suit your needs. Their banks are offering overdraft funding. You pay interest on the amount you overdrawn each day. There are financing facility of lenders that provide a more significant amount of credit but higher risks and complex requirements. Step 6. Check if you qualify for any startup financing support. Thus, the skills and requirements depend on the institution offering the loan opportunity for starting up businesses. Also, prepare all the documents and make a self-assessment to build your confidence to make the loan application get the approval. Step 7. It is advisable that you should not rely on your business startup to financing. You may have saved some money where you can use to start up. You might also have some investments you can sell to use the profit as startup capital. The point here is that you should diversify the source of fund to kick off your business. The government is now helping and encouraging entrepreneurs to set up a business and open accessible fund sources. However, as a business newbie or starting a new business in town, you must always remember that nothing is free. Lenders often look for something in return for their money that goes out via credit. Usually, a loan will need collateral or personal guarantee. The top startup financing strategies. Crowdfunding. The concept is to use the power of online platforms such as social media. The crowdfunding strategy could be peer-to-peer lending, peer-to-business lending, reward-based, and equity. Peer-to-peer lending will involve individual investors lending money to an individual for a fixed interest rate. Peer-to-business is a loan for business via investors, companies or government institutions. Reward-based crowdfunding is you receive funds from investors in exchange for your products or services. Equity crowdfunding is offering shares or equity of your company in exchange for investment. Usually, reward-based crowdfunding is the most effective and fastest for a startup business. Crowdfunding technique has been popular not only for having a lesser risk, but it rewards unique and innovative business ideas. Short-term loans. These are straight loans with a pre-agreed period and interest rates. The loan period is the shorter and higher interest rate. The investment is relatively expensive. There is a need to have some security or guarantee to acquire the credit facility. If your company have outstanding invoices, this loan facility is the right one for you. For banks, they can loan up to 85 to 90% the value of the unpaid invoices. These can be paid back once you receive the payments. Business grants. The government is empowering the startup businesses. The Local Enterprise Partnership, LEP, is one of the government grants that offer grants in countries within the EU. The Competitiveness of Enterprise and SME, COSME, of the European Commission also provides funding for small and medium enterprises. Competitions can also be a great opportunity to source for funding. For example, the VOOM pitch of the Virgin Enterprise gives the starting business the chance to pitch their concepts and innovation to Sir Richard Branson and win prize money. Angels. There are wealthy individuals and retired company executive who are still wanting to be in the business field. These people are always willing to invest directly to small firms owned by others. They are seasoned and full of wisdom in their area that can contribute experience, network, technical knowledge, and management knowledge. Because of their rich experience, they have the right to supervise management practices. It can be done by taking a seat on the board of directors. Venture capital. Venture capital is a specific startup financing strategy. The capitalist habitually looks for technology-driven business with the potential to grow big. Usually, the venture capitals take an equity position in the company. It is because they want to be part of managing the high risk and high return of their investment. If you're going to venture in capitalism, be sure that the investor will bring relevant experience and knowledge for your business. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.